Do you want to make passive income to pay for your vacation or occasional dinners at a fancy restaurants? Well, there are a few ways you can do this. Either you set up an automated business or own a rental property, or invest in securities that the financial markets offer. Now, the starting two require huge capital to begin with, but the latter not much. To get started with investing, a decent income of around $35,000 shall be sufficient. Knowing how each type of financial market works and the type of security it provides is important to create a diverse investment portfolio, as this depends upon whether you're a defensive investor or person who's willing to risk it all in hope of higher rewards. Let me take you through the different markets and securities so you can opt what's best for you. A debt security is an obligation to repay borrowed funds along with an interest on it as soon as the contract matures. Now, you may think that this is basically a form of loan, but it isn't. Generally, loans are not classified under debt securities as they usually have low interest rates and are non-negotiable. Debt securities tend to be more flexible. Bonds are a specific type of debt securities usually issued by the government or corporations for borrowing money and promise to pay it back. Debt securities come under capital market, whereas treasuries and CDs come under money market. Capital and money markets are the two types of financial markets. Money markets comparatively have more liquidity than capital markets and usually have a short period of maturation too. It has very less risk and hence the ROI too is not much. Another form of capital market is equity securities. Unlike debt securities, where you earn profit through interest, in an equity security you lend money in exchange of a small percentage of ownership in the company. Equities carry on a higher stake. A mutual fund can be of both debt or equity-based security. I'll explain about it in detail in the next video. If you're looking for capital appreciation over a long term, it would be best suggested to go with capital markets. Although money market seems to be less riskier option, profits from it would be low, which would not help keep up with inflation rates. Debt and equity securities offer a wide range of investments that can help you build your wealth in the long run. But which one would be a better investment? This depends upon the individual's net income and the amount of risk he or she is willing to take, and other personal preferences. Let's understand both the securities to see which one will suit you the best. First, let's understand debt securities. Like I said, debt securities such as bonds are offered by government or businesses to run required operations efficiently and promise to pay principal amount with interest. So investors who are looking for low risk can opt for such a contract. You can withdraw your investment after 12 years, but if you do it before 5 years, you will lose whatever interest you earned on it from past 3 months. But most of profits will be reduced due to taxes, and inflation rates too will affect this. For many people who are looking forward to get started in real estate, mortgage-backed security is another debt security in which the investor loans a particular sum of money to a real estate agent, and he or she should pay it back with a negotiable, unfixed interest rate. But if you fail to pay back then, the investor may claim your property as collateral. Commercial papers, too, are an example of debt securities. They're almost the same as bonds, but have a less maturation date, which is usually less than a year. These are mostly issued by corporations to finance inventory and other short-term liabilities. And yes, due to its time of maturation, it can be considered as a money market instrument. Now let's talk about equity securities. As discussed before, unlike debt securities, equity securities offer a percentage of ownership on the earnings and assets of a company. Returns on debt securities are fixed interest payments, but equities offer potential dividends and capital gains. However, equity securities carry risks. If the company underperforms or the market declines, their value can drop. Unlike debt securities, they don't guarantee returns, making them more volatile and potentially leading to losses for investors. Various types of stocks such as common, preferred, options are examples of equity securities. A hybrid security is an asset that has the features of both equity and debt securities. Convertible bonds, balanced funds containing a percentage of each bond and stocks are examples of hybrid securities. It generally offers higher returns than traditional bond offerings. Also provides an opportunity to participate in a firm's growth if there is an uptick in the company's common stock. The combination of securities used are complex and may require good understanding of each type to be able to identify the best combination. This often becomes difficult for small retail investors who may not have so much detailed knowledge. Now, apart from all these, there's another financial market known as derivatives. It's widely known for its system of advanced risk management. A derivative market derives its value from an underlying asset such as a stock. There are three main types of derivative: futures, options, and swaps. I'll explain about all the derivatives and how it works in another video, as it isn't a small topic. But how would you know if it's the market for you to invest in? Derivative markets allow you to take control of large positions even with a small investment. It allows you to hedge against potential losses and help amplify the returns. Now, you may wonder how this is possible. This is due to the nature of the market. It's more of a bet between the seller and buyer. I won't get into detail about it, as this video is only for giving you an idea of all the fundamental markets. Along with its advantages, there comes few disadvantages too. As I said, the value of a derivative contract relies on the underlying asset, such as a stock. And stock prices often tend to fluctuate rapidly. And derivatives involve a lot of strategic and tactical thinking, so a bad plan might result in a loss. Although they aren't a beginner-friendly market, but once you've mastered the concepts and different aspects of it, it is a great market to invest in. This is not all that you need to know to start investing, as there is so much more to talk about. But this should be enough to begin with. I'll make more content on how you can create a diverse investment portfolio that'll help you hedge against losses and inflation, along with getting profits through dividends and interests.